Hey guys, this is Florian from Breakout Investors. We want to try something new today and we want to add a little bit more to our YouTube content and the video library. So far we have pretty much only done calls with management on YouTube, and let's see how this goes, but we aim at adding a bit more of that type of content. And what I want to do today is use the opportunity for this first kind of video of this sorts to add a little bit of commentary to the LCFY results that were reported last week. I want to try to keep this relatively short. There will be some bonus content in the end, so make sure you listen to all of it. And so let's get started. This is not going to be an in-depth description or thesis on LCFY. I have that out there for you to read. Just some commentary on the recent results. So on the face of it, it looks pretty bad, mainly because total operating revenue decreased 28%. And keep in mind, this is for the first 6 months of their fiscal 2024, ending in December 31. So all these numbers are for 2 quarters, ending December 31. So this is nothing related to January, February, March, right? So it looks bad because revenue decreased again. Now what they focus on in the very first part is the aggressive cost cuts and the partnerships they have closed. So to put this in context, they have been pretty aggressive in really reducing the operating expenses, but also the direct expenses associated with their basically services. So cost of goods sold has come down a lot. This is reflected in the gross margin, which is yet again 81%, something like that. It was very similar in the first quarter, and this will continue to be in that range most likely. You can see it very drastically. Cost of sales down from 888,000 to 300,000, right? So very stark. And they add a little bit more details on the operating expenses, what they have cut, and it's down quite a lot. Now, of course, revenues are down, so they still had a net loss and also still burn cash. So again, it looks fairly not good, at least on the face of it. Same with these key KPIs, right? MRR, active resellers, and users, all slightly down. So let me add a little bit of commentary before I touch on the partnerships. These KPIs have been trending down for a while, and the MRR trending down is of course associated with the revenues. With the resellers, Gavin has communicated they're focusing more on their bigger resellers, so it's not a big surprise that the raw number has come down. And end user count is obviously also related to declining revenue. They mentioned in the beginning that revenue has been declining for a number of reasons. One of them is, of course, they have transitioned to a new tech platform. Associated with that was some billing relief that they used to keep their clients and keep them locked in more or less, which of course was one of the reasons for declining revenue. I had thought this was done in the first quarter, but what I have learned subsequently is there was additional billing relief also in the December 31 quarter, which is ending, however. So already there, and they are not saying this unfortunately, but already the billing relief ending will contribute to increasing revenues from the baseline of Q2. Now, additionally, they highlight pretty prominently that there were some algorithmic changes. And that of course refers to Google, and as you can see here, content-based sites, traffic losses caused by these algorithm updates, sometimes in excess of 90%. So Google has implemented a number of changes in the past couple of months, beginning I would say mid last year. Some of them related to AI, some of them related to other things. You can look that up for yourselves, but if you look around in the CEO community, that was pretty hard hitting. And the 90% number is real, and that has contributed to a number of clients also of Locify being hit very hard. Specifically also the big publisher that was announced in June, and it was so bad that Locify was not even able to fix it, at least not very quickly. And what I've learned is that the communication to Locify never really laid that bare very well. So Locify really learned of how hard this potential client was hit in the last couple of weeks and months. And that's also why the large orders we have been waiting for haven't materialized yet. It is basically that this client or potential client was hit so hard that they need to restructure a lot of their sites, because in the stage they are in, they are just not viable for search engine optimization. It's just not working. Article Accelerator, just for most of these, just wouldn't work properly, because either they are de-indexed or they are so heavily penalized by Google that it's just not going to work. And that has hit several of Locify's clients, and that also contributed to the revenue decline. Now, again, it looks bad, and let me add another negative. We can look at the cash position, and the cash position is, as of December 31, just above 700,000 Australian dollars. Now, they have burned about 600,000. So this cash flow statement is, of course, for 6 months. We can ignore purchase of intellectual property. That is not going to be repeated. But if we add the financing and operating activities, see it's about 1,300 Australian dollars. Now, if we look at Q1, which I have here as well, right, the cash burn was, again, operating activities and financing was about 940. So in the last quarter, it wasn't that much actually, just 400,000 Australian dollars, something like that. And so it's fair to assume they burn around per month, something like between 100 and 200,000 Australian dollars. So it's getting very close, right? This is not a lot of cash they have, and this is certainly something to watch. Now, we know they have an ATM out there. They could use the ATM, of course, to get some additional cash, or, and that's what I've learned from talking to the CFO, they are looking at a number of other opportunities to raise additional cash if needed. There are a number of ways they could do it. Maybe some kind of bought deal, but also non-dilutive ways. A loan, an advance from Didner, for example. So we will have to see how this goes. And keep in mind the cash burn is not that high, right? So it's probably, if you combine that with what I'm going to talk about next, not as bad as it might seem. So to me, they probably have to raise some additional cash, but it's not going to be that significant, at least what I would expect. And that is because, and they don't talk about this at all, which drives me pretty mad. As of the date of this publication, calendar Q1, their Q3 was already over. And you won't find a single comment on how this went. And what I'm happy to tell you is, not only because of the building relief going away, but also because of the resellers, all of that has been stabilizing. So it is very fair to assume, and I don't know what the revenue was, of course. They certainly haven't told me, but it is very fair to assume that the quarter just ended, calendar Q1, their Q3, is better, much better in terms of revenue than Q1 and Q2 were. And what they also do not mention is that these cost cuts go even further. There will be, or have been, additional cost cuts in calendar Q1. And what I have learned is that additionally, there are more cost cuts in the quarter we are in. So operating expenses will go down even further. And so if you add just a little bit of revenue growth from the baseline we had here, right, then it's not hard to imagine them not only getting profitable. I pretty much expect them to be profitable in the quarter we are in right now, their Q4, calendar Q2. Not only that, but they will also be cash flow positive. And so things to me look like they have bottomed. And this is, of course, reflected in the stock, right, which is at its lows, unfortunately, because it is a very big position for me. But I am very optimistic that this is now as bad as it gets. So let me add some commentary on the partnerships. They highlight, of course, Localista, and this is the first step towards them adding media assets to their own library to manage, so to say. So they basically cut out the middleman and take the ad revenue they can generate from that themselves. Much more important is the relationship with Didner. So they highlight that paid trials have begun, and what I have heard is that these trials are going very well, which is of course very good. And not only that, I'm expecting additional agreements with Didner to be signed in the very short term, which basically, I don't know what exactly they will have and they will publish about that or release about that, but it's more or less about the revenue split from using Article Accelerator to the publishers' sites that Didner is already working with. And let me tell you, Didner, which is a private company, so you won't find a lot about them, but they have some very impressive clients. I would just highlight one of them, which is what I have learned is ESPN. I guess everybody has heard about them. But the very big ones like ESPN, I don't think LCFY will start to work with those in the beginning. They will focus more on the small to medium term ones, because that's just easier for them to get in and easier to generate quick revenues. So the relationship with Didner is basically such that LCFY has very quick access to all these relationships that Didner already has to publishers, and there is a lot of relatively quick revenue that can be generated from that. Now, I have no idea how fast it will go, how quickly they can ramp it, but the opportunity is certainly in the millions of dollars in terms of revenue. And that's not even taking into account using Article Accelerator on all the media sites of these publishers, which is going to be subject of another agreement that is probably going to be released in the near future. But overall, the agreement, I would describe it as such. Didner is very good at improving the ad revenues you can generate from your site. That is what they are really good at, whereas LCFY is good at increasing the traffic to your site. So you can see those two are highly complementary, and what they are looking to do is, beyond the first trials, is basically split the additional revenue created from a certain baseline. What that split exactly is I think a bit variable. It's sometimes 50-50, sometimes 70-30, but whatever it is, right? It's revenue that is very easily generated, with not a lot of costs associated with them to Locify. So and same for Dinner, of course. So it's a win-win for both companies, and I think they will be pushing very hard to get that going. So this relationship with Dinner is really exciting and coming more or less out of the blue. We breakout investors have introduced the two companies to each other, which I'm very happy to say. That has worked very well, and let's see how this goes. It's certainly very exciting what they are working on, and I promised something good towards the end. I talked in the beginning about this one publisher that was announced in June. They have been hit very hard by the algorithm changes from Google. Now, this publisher, of course, works with a number of agencies. And we know, because Locify has announced it, that they have received first orders. And what I've learned, and there's nothing ever came additionally out of that, right? But what I've learned is that one of these agencies where Locify has already performed work, they were so happy with the results that they have, separate from this big media company, approached Locify recently to work with them. So not only does it show that the technology works and the customer, this agency, was very happy, but it adds immediate opportunity, right, to use Article Accelerator on the media assets they have, besides the big publisher. And I am optimistic that there's going to be some revenue being generated, some material revenue being generated from that as well. So let's see what we can learn more from that. Let's see how this goes. I think they will be meeting in the near future, and yeah, let's see. And the other thing worth mentioning is that this big publisher that was hit so hard by the Google algorithm changes, they are engaging now with Locify in order for Locify to help them fix these issues. And of course, Locify doesn't have the manpower like to do all the bottom-up work, but I think there is scope for some advising work, and I would say that could also provide some revenue to Locify. And if this works out really well, maybe the use of Article Accelerator in not the near future, but maybe in a year or so, is still feasible and possible, and that opportunity is of course massive. So we will see where this goes. There's a lot going on with Locify. Not all is bad. In fact, I would say the bad stuff is mostly out of the way. We just have to see now how they're dealing with cash. But overall, there is a lot of good going on. Again, I think revenues have bottomed, and profitability is not that far away either. So yeah, the stock is of course not exactly pleasant at the moment, but it looks to have bottomed, and I think the upside is still massive, especially with this Dinner relationship and all the things they have going on. So yeah, let's see where this goes. I am still very optimistic about the company, and I hope you like this. Let's see what we will do in the future with this type of content. And yeah, thanks for listening, and see you guys.
Neither Breakout Investors nor any of its affiliates makes any representation or warranty, express or implied, as the accuracy or completeness of the statements or any information presented by this podcast, and any liability, including in respect to direct, indirect, or consequential loss or damage, therefore is expressly disclaimed. The views on this podcast expressed are those of the speaker and not Breakout investors. No one on this podcast is an investment advisor, and no one is providing investment advice. Before investing in any company stock, you must do your own research. Thank you for listening.